Did you know that trading currencies can be very dangerous? Forex trading is almost entirely unregulated around the world, accompanied by high risks of losing so much of your money. If you're part of the little number of people who have absolutely no clue about what Forex trading is, you've come to the right place. Hello everybody and welcome back to Investor Info. In today's video we'll be diving into our Forex trading guide for beginners. Let's get started. The international market is full of banks that trade with one another all around the world. Banks must assess and absorb sovereign and credit risk, and they have to put in place internal safeguards to make themselves as secure as possible. Regulations like these are set by the industry to safeguard each participating bank. Because the market is created by each participating bank making offers and bids for a certain currency, the market pricing process is based on supply and demand. Because the system has such enormous trading volumes, it is impossible for rogue traders to affect currency prices. This technique contributes to market transparency for investors who have access to interbank trading. Most small retail traders deal with unregulated Forex brokers or dealers that may requote rates and even trade against their own clients. There may be certain government and industry restrictions in place based on where the dealer operates, but even those safeguards are uneven throughout the world. Most individual investors should investigate a Forex dealer to see if it is licensed in the United States or the United Kingdom. This is because the US and the UK dealers have more monitoring. Or investors should see if it is regulated in a nation with loose laws and control. It's also a good way of finding out what type of account safeguards are available in the event of a market downturn or if a dealer goes bankrupt. Forex is a combination of the words foreign currency and exchange. Foreign exchange is the process of converting one currency into another for a number of purposes, most notably business, trade, or tourism. Currency is significant because it allows us to buy goods and services both locally and across borders. To undertake foreign commerce and business, international currencies must be exchanged. If you live in the United States and decide to buy cheese from France, you or the firm from whom you buy the cheese must pay the French in euros. This implies that the importer in the United States would have to convert the equal value of US dollars into euros. The same is true for traveling. Because euros are not the native currency, a French tourist visiting Egypt cannot purchase in euros to see the pyramids. The traveler must convert his or her euros for the local currency, in this case the Egyptian pound, at the exchange rate at the time. Trading Forex is comparable to trading stocks. Here are some methods to help you get started in Forex trading. While not difficult, Forex trading is an enterprise in and of itself that needs specialized understanding. Forex trades, for example, have a larger leverage ratio than stocks, and the determinants of currency price movement differ from those of equity markets. For novices, there are various online courses available that tell you everything you need to know about Forex trading. To begin Forex trading, you will need to have a Forex trading account at a brokerage. Commissions are not charged by Forex brokers. Instead, they profit on the spreads, also known as pips, that exist between purchasing and selling prices. Setting up a small Forex trading account with minimum capital requirements is a smart option for new traders. These accounts feature flexible trading limitations and permit brokers to limit trades to as little as 1,000 units of a currency. A regular account lot is equivalent to 100,000 cash units. A micro Forex account will assist you in becoming more familiar with Forex trading and determining your trading style. While it's not always feasible to foresee and time market action, establishing a trading strategy will assist you in establishing broad principles and a trading roadmap. A smart trading strategy relies on the realities of your financial situation and status. It takes into consideration the amount of money you are prepared to deal for trading, as well as the level of risk you can accept before losing your position. Keep in mind that Forex trading is primarily a high-leverage environment. However, it also provides greater benefits to those who are prepared to accept the risk. When you first start trading, always double-check your positions at the end of each day. Most trading software already includes a daily trade accounting. Check to see if you have any outstanding positions that need to be filled, and whether you have enough funds in your account to execute future transactions. One distinguishing feature of this international market is the absence of a central outlet for foreign exchange. Currency trading is instead done electronically over the counter, which implies that all transactions take place over networks among traders all over the world, rather than on a single controlled exchange. The market is open 24 hours a day, 5.5 days a week, and currencies are traded across practically every time zone. This implies that when the trading day in the United States finishes, the currency market in Hong Kong begins afresh. As a result, the currency market may be quite busy at any moment, with price quotations changing on a regular basis. Before we discuss more about Forex trading, please be sure to hit that like button and subscribe to our channel to stay up to date on the world of investing. You are not going to want to miss out on all the exciting content we have in store. But for now, let's return to the video. Let's talk a little bit about how Forex trading came to be and its history. The Forex market in its most basic form has been operating for millennia. To acquire products and services, people have long swapped or bartered items and money. However, as we know it today, the Forex market is a very new idea. Following the breakdown of the Bretton Woods Agreement in 1971, additional currencies were permitted to move freely against each other. Individual currency values fluctuate based on demand and circulation and are tracked by foreign exchange trading services. The majority of Forex trading is done on behalf of customers by commercial and investment banks, but there are also speculative possibilities for skilled and individual investors to trade one currency against another. The fact that there are no main sites that serve as trading platforms for the international currency markets is an intriguing element of the markets. It is instead a series of linkages formed via trade stations and computer networks. Establishments, investment banks, commercial banks, and individual investors all participate in this market. When individuals talk about the Forex market, they typically mean the spot market. Forwards and futures markets are more popular with businesses that need to manage their foreign exchange risks until a certain date in the future. Because it trades in the largest fundamental major asset for the forwards and futures markets, Forex trading in the spot market has always been the largest. Previously, volumes in forwards and futures markets outpaced those in spot markets. However, with the introduction of computerized trading and the spread of Forex brokers, trading quantities increased. The spot market is where commodities are purchased and sold depending on their current trading price. The price is established by supply and demand and is computed based on a number of variables, including current market rates, economic performance, feeling toward ongoing political circumstances both locally and internationally, and assessment of one currency's future performance versus another. A spot deal is a completed transaction. It is a commercial trade in which one party provides an agreed-upon quantity of one currency to the counterparty and gets an agreed price of another currency at the accepted exchange rate value. When a position is concluded, it is settled in cash. A forwards contract is a confidential agreement between two parties in the OTC markets to acquire currencies in the future and at a fixed price. A futures contract is a regulated contract between two parties to take possession of a currency at a defined price and date in the future. These contracts are traded on exchanges rather than over the counter. Forwards contracts are purchased and sold over the counter between two parties who agree on the parameters of the transaction. Futures contracts, on the other hand, are purchased and sold on open commodities markets based on a defined size and settlement date. Unlike the spot market, they do not exchange real currencies. They instead engage in contracts that indicate claims to a given currency form, a specific unit cost, and a future settlement date. Both forms are legally binding and are normally resolved for dollars at the exchange in issue when they expire. However, they can be purchased and sold before they expire. Moreover, currency forwards and futures markets can provide risk protection when trading currencies. These markets are typically used by large international firms to protect against future currency rate volatility, although speculators also participate. Companies conducting business in other nations are vulnerable to currency swings when they acquire or sell products and services even outside their native market. Foreign exchange markets allow you to hedge currency risk by establishing a fixed rate at which the deal will be executed. To do this, a trader can purchase or sell currencies in advance to lock in an exchange rate. Assume a corporation intends to sell American-made food processors in Europe when the euro-dollar exchange rate is €1 to $1 at parity. This type of hedging is possible in the currency futures market. The trader benefits from the fact that futures contracts are structured and approved by a central authority. Currency futures, on the other hand, may be less liquidated than forwards markets, which are unregulated and exist around the world through the interbank system. Rate of interest, trade flows, tourism, economic stability, and geopolitical risk all influence currency supply and demand, resulting in daily volatility in the foreign exchange markets. There is a potential to profit from fluctuations in the value of one currency in relation to another. Because currencies are traded in pairs, predicting that one currency would weaken is practically the same as predicting that the other currency in the combination will rise. And there you have it, folks. Now that we've discussed a thing or two about Forex trading, let us know in the comment section down below your thoughts on it. Would you be willing to face the risks that come with Forex trading, or would you rather play it safe? Whatever you choose to do, remember to always do your research and make the most of your resources. If you found this video helpful, feel free to leave a like and subscribe to our channel for more videos just like this one. See you in the next video!